How bored has the average young adult been during the course of this COVID lockdown, and what entertainment options have they chosen? Well, we got some interesting numbers that we're going to share on this segment in the program, and it's going to come as a bit of a surprise to a lot of folks what we're going to share on this segment, but the numbers are pretty staggering. Welcome back to Dollars and Cents, where we help you make sense out of all of those different decisions that involve your dollars. Here on the program, we are Central Florida's longest running radio program, coming to you on Sunday mornings on the News Radio WFLA Orlando network, along with 96.9 The Game. Also, our program happens to be one of the top 25 financial planning podcasts on the World Wide Web, with over 11,000 downloads of our podcast. So be sure and check out our podcast channels on Google and iTunes and iHeartMedia as well, along with Spotify. So make sure you check us out there and subscribe to our channels. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful financial plan that provides peace of mind for the future. So, what's the latest sport? Well, it's a redo of what we saw 20 odd years ago. There's no real competitive options out there. You can't watch ESPN, you can't watch football, basketball, baseball, whatever your sport of preference is. And you can't even go to the gym and play a pickup basketball game. So to cure that isolation, to cure that boredom, and to get those competitive juices flowing, apparently everybody's decided to become a day trader these days. Here are the numbers. E-Trade, which is one of the biggest online trading platforms, investors open over 260,000 retail accounts just in the month of May. That is more than any full year on record in terms of account openings. Not to be outdone, newer rival Robinhood, another trading platform that has a very popular app, had a record 3 million new accounts open in the first quarter of this year. Trades by individuals, investors, have more than doubled the usual retail activity, and individuals now account for, on some days, up to 25% of stock market activity on a given day. That is more than double the activity of prior years. The average age of those 3 million new accounts on the Robinhood app, 31. So let's talk about that. A lot of information, a lot of folks heading in that direction that are younger, that are perhaps maybe missing their sports, missing that competitive edge, and they've decided to trade stocks as their sport of choice. Good thing we're on 96.9 The Game, right? Because then that way we can kind of tie all this into sports, because there's not much sports going on. Pretty much the only NBA has kind of figured it out. Everybody else looks like they're falling apart. And so there's not many options. So you got a lot of people that are opening up trading accounts to get their competitive juices flowing. Well, before you go ahead and open up that account, let's talk about it and put that into some perspective based upon kind of what the risks are and what history. So average age 31 on those new accounts. If you're 31, you probably really don't know about Y2K and the dot-com bubble of the late 90s. Maybe you've heard of it, but you didn't see it, you didn't experience it. And so that history lesson is that during that time, there was a bunch of tech companies who weren't really making any money, saw prices surge dramatically, creating this day trading phenomenon. That's when it really kind of first started. And the view was it just couldn't go down. And what's interesting about that period of time is I actually had kind of a front row seat to that, because back in the mid to late 90s, I was actually an attorney, and was actually a securities law attorney, and my job was to write the prospectuses that you would give to investors to encourage them to invest in a particular company. And the reality is that back then you could do something known as pro forma financial statements. And basically pro forma should have been like another fancy word of saying, hey, what's the best case scenario? And if it is the best case scenario, here's how that's going to impact my financial statements. And the reality is everybody was doing it. And obviously there's been regulations that have passed that prevent that use of pro forma financial statements like they were being used back in the 90s. But it created the illusion that these companies were going to be someday highly profitable if events A, B, C, D, E, and F all happen simultaneously. The reality is, though, that because none of that happens simultaneously, then it creates a bubble, and it created the obsession of day trading. And of course, now we see that resurrecting itself. And this time, thanks to social media, we don't have to write massive prospectuses with pro forma financial statements. We can just hop into a chat room and chat up a particular stock. 20 years ago, they were known as boiler rooms, where you would actually pick up the phone and call people to try and entice them to buy a stock. Nowadays, you just log on to your computer, poof, you're in a chat room, and you can encourage purchasing of a particular company along the way. The reality is that in today's world with social media, that type of an approach has certainly been amplified by tenfold indeed. Number two, in terms of history, risk, and perspective, the access to highly sophisticated trading strategies is probably one of the most truly troubling developments of this. This is probably new since the last time we saw day trading amidst the dot-com bubble of the late 90s get really popular, is that this time around there's a lot more sophisticated high-risk trading strategies that are available that weren't available back then. And this is where you got to be really careful, because in the traditional setting, a brokerage firm is required to know their customer and approve strategies like options trading or margin trading or things like that, based upon the conversation with the customer in terms of determining their level of sophistication. Well, today with these online platforms, with these apps that are out there, nobody's really sort of having that conversation. It's really more, just kind of click through and sign on and enroll and, double check the answers. But for the most part, you can get access to some pretty sophisticated trading strategies, and it's really just a click away. The problem with those trading strategies is that options trading can do very bad things very, very quickly, particularly with some of the strategies that make it possible for you to lose more than what you put in, and still other strategies where there's no limit to how much you can lose. And there is a very tragic story out there involving an Alex Kearns, and this really is pretty tragic, who did one of these strategies where you can have unlimited losses, not really knowing what they were doing, didn't have any income. They got online, they were 20 years of age, they got into these unlimited downside, highly sophisticated trading strategies, and with no income, he proceeded to rack up a loss that was showing in his account of $750,000. The story is tragic because Alex committed suicide in reaction to that sizable loss in his account. Obviously, the SEC has gotten involved in this, and ultimately, you're going to see those options start to shrink. But folks, this is some serious stuff when you start talking about the easy access to highly, highly sophisticated options trading strategies that can create a massive loss without you realizing it. And that's the truly tragic part of it. And perhaps one of the biggest ways that what's going on today is different than what went on 20 years ago is the access is much easier for much more sophisticated strategies. We're going to take a break. When we get back, we're going to continue this conversation on the latest thing that's happening out there in terms of day trading and the sport that it has become. when we return here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Talking about the startling rise in day trading and online trading that's happened, particularly during the course of this year as a result of the COVID pandemic, just locking everybody in and eliminating sports, and folks need an outlet. And so when you look at, for example, like the Robinhood app, average age of a person that is opening an account is age 31. In the first quarter alone, there were 3 million new accounts. So wanted to spend some time on the program talking with you about some of the risks involved in that, give it some perspective and some history lesson on it. And what we're talking about before the break was obviously back in the late 90s, the dot-com bubble, Y2K, that created sort of the first run on the day trading phenomenon, and a lot of people got involved in that, and ultimately things certainly did not end well for a lot of those dot-com companies. And then the second thing that we shared is that there are a lot more highly sophisticated trading strategies that are available out there today that there was not. We shared with you the incredibly tragic story of a young man, Alex Kearns, who got involved in those sophisticated trading strategies, and all of a sudden his account is showing that he's lost $750,000. It's a tragic story in that Alex committed suicide as a result of that, and the SEC and FINRA has certainly gotten involved as a result of that. But just understand that the trading strategies are much more sophisticated that you can get access to with these online platforms these days. So be very aware of that. And then third, the reality is it's the old pump and dump. And that's the thing that you have to be careful about, is the notion of a pump and dump scheme has certainly been around. It's a very simple fraud whereby somebody starts pumping up somebody buys a particular stock of a particular company. They start then pumping it up, and basically, talking about it and creating stories and doing episodes on it. And ultimately, when that starts to generate interest, as you might well imagine, if you have more interest in a particular stock, more people buying it, well, guess what happens to the price, right? Fundamental supply and demand. If you got people demanding it, it's going to send the price up. And then when the price goes up, well, that is when you dump it. That's the notion of a pump and dump type of strategy. And today it's easier than ever to do that because of the power of social media platforms. So you've got a lot more of that kind of in the wings as well. So just be very careful of that, because what's happening in these chat rooms is sort of one of the oldest types of frauds out there, in the form of a kind of a bait and switch, pump and dump type of scenario. And then lastly, when it comes to these trading platforms and day trading, there's the reality. For every success story that you hear somebody talk about, there is a much greater degree of failures on it. And you only hear people really talk about how, the trade that they made money on, not necessarily all the different trades that they lost money on. And so it's kind of like how you think of sports, to relate it back to sports, right? Everybody remembers the notion of taking the winning shot and having it go in. They sort of forget along the way of all those other shots that they took that didn't go in. And so when it comes to investing and trading, I think oftentimes you kind of get that same mentality, that we as human beings remember the successes and the failures all sort of get muddled together. But you have to take the failures and the successes, and ultimately that drives your rate of return. And what's interesting about that, if you look at the actual trading data based upon Robinhood customers, and again, Robinhood, one of the more popular trading apps out there these days. If you look at the trading data between March and early June, the conclusion based upon the academic studies that's been done on it is that the more a specific stock was bought, the more popular it was, the worse, in fact, it performed. So folks, steer clear of this. If you're looking for something to be less bored or to do something more exciting, look elsewhere than simply playing with your money like this. Money is not a game. It's not a sport. It's supposed to be set aside so that you can have a better life later on. So be careful about this. Fortunately, sports is sort of coming back. So maybe that will slow down the amount of people that are looking to day trade as their sport of choice. Speaking of investing, it is certainly these days a tale of two cities out there, if you will, in the market. You have the tech stocks and those kinds of things doing really well. And we certainly talked about that on the program before, but then there's sort of the other side. And then when you look at the S&P 500, which is the 500 largest companies in America, 35% of those companies are down, still down about 20% since the beginning of the year through the end of July, even though the overall index is up about 2%. So the tech giants are certainly driving a lot of the performance of the index, but there's about a third that's still down and down pretty dramatically. And so as an investor, that's why it's so important to really drill down into the actual details of what's in your investment portfolio. And we're going to give you three things as we conclude the program here in our last segment. We're going to give you three things that investors really should be looking at today to really get an insight into exactly what's going on inside their portfolio, because there really is a dichotomy, if you will, that exists out there in the market today based upon sectors that are doing well and sectors that are not. And I guess that gets us really to our first question, is that when you look at your investment portfolio, it's not enough to just kind of look at, okay, I own Fund A, Fund B, and Fund C, but you really want to drill down and look at what sectors do you truly own, right? I mean, there's a difference between how tech, healthcare, and communications services is doing these days versus, say, energy or real estate or travel and leisure. So it's important to have that information on your portfolio as a whole and be able to do that analysis of what the underlying sectors are in the investment mix that you have. Not enough to just look at the funds or the investments, but really take it a step further in terms of those details. And then along those same lines, you would want to look at what are your top holdings, because you want to be there looking at company concentration. You don't want your portfolio skewing to the point where you're owning 10% of a single company. That would certainly undermine the diversification that you're looking for in your portfolio. So it's important to kind of drill down past the sector allocation, but into, okay, what's the company concentration that I own sort of across the board? Because if you look at a company like, say, Microsoft or Amazon or Google, a lot of funds and investments will own those particular companies. And so you need to know, okay, fine, I might own the same company in Fund A or Fund B or Fund C, but at the end of the day, what's my total exposure across my portfolio look like? And so drilling down into it and kind of looking at your top individual corporate holdings is a great way to do that, because you certainly want to be careful that you don't have an over concentration in one particular company, particularly on those companies that happen to be the more popular holdings. And then number three, really looking at how you are doing relative to the applicable benchmark, because after all, that's what it's all about. You really want to be able to have some basis of comparison. It's not enough to just look at performance, but make sure you're looking at that performance relative to what the overall benchmark, the overall markets have done. And that, after all, is sort of where the rubber hits the road, right? How you've done versus the benchmark is incredibly important. So as an investor, make sure you're doing that comparative analysis on how you're doing today. Look at sectors, look at individual companies, and then look at relative performance. So those are the three main categories that you want to be looking at today to really get a good insight into what's going on, particularly when we have this sort of tale of two cities that's happening in the markets today, where you've got big sectors that are down still a lot and others that aren't. We're going to wrap it on up and get on out of here. Thanks for listening to the program Dollars and Cents here on News Radio WFLA 96.9 The Game. If you're interested in catching the program again, be sure to check us out on our social media platforms at Nelson Financial Planning. Thanks for listening to the show.